so that when that distribution happens, it's not a big shock to the system. It's actually part of the plan we've already discussed, and the transition from not having the money to having it is smooth.
Most people really buy into the idea of, okay, these are assets that someone's done well in the family and they genuinely want to provide, not just for your generation, but for your children. That's quite an easy concept for most people to buy into, obviously more challenging when you're young, but people really do understand that, and it's a lovely thing to be part of. I think also, probably we've all seen it, that if money comes too easily, you don't appreciate it and you don't learn enough about it. And so that's also a difficult message to understand at the time, but most people setting up a trust do not want to deprive their children of ambition and achieving success on their own terms.
Today we're discussing the case study of a 28-year-old beneficiary receiving £300,000 for a first property purchase. We're going to get into the detail in a moment, but first I'm going to come to my two guests, starting with you, Dhana.
Thanks, David. I'm Dhana Sabanathan. I head up our private client team at the law firm Michelmores, and we specialise in tax, trust and estate planning.
Fantastic. Adam.
Good morning. My name is Adam Canavan. I'm one of the financial planners at Bowmore Financial Planning, and we work with people such as the beneficiary we're going to discuss to help them understand how the distribution of a large sum of money impacts their lives and how to make sure they have a financial plan going forward.
So the beneficiary, Charlotte in this case, is about to receive the first major distribution from a family trust, £300,000 to help her get on the property ladder. She's never engaged with financial planning before. What's the most important thing for her to understand before this money is received?
Absolutely. So it's really that, in this case for Charlotte, is very much that education piece of helping her understand the implications of receiving this very large sum of money that she's not had before, with particular focus on certain things she's looking at the moment. So understanding how property purchases works, things like stamp duty that she's going to have to pay. Also helping her understand her attitude towards lending and what potential mortgage options might be appropriate for her. So it goes back to very basic fundamentals of understanding how this impacts her life and the choices that she now has based on distribution.
So the full picture will be like a salary as well,
Absolutely.
Another thing, like look at things she might be receiving, the workplace pension, things like that even, you know?
Yeah, absolutely. So we very much view the way we work is we want to understand the full picture and take what we call a helicopter view. And we recognise that this distribution that's coming into Charlotte isn't something in isolation. It's going to interact with her earnings, her other savings and investments, her pension that she's got, whatever it may be. And to get the right outcome for her, we need to see how all the cogs fit together.
And, you know, she is still young, starting out her career. What kind of planning considerations are relevant at this moment? She might be repaying student loans, there's different things going on, starting to contribute to a pension. But with a younger person, what kind of thing do you start kind of coaching them on from the financial side?
Yeah, so it's always slightly different with a younger person, because I suppose a lot of their objectives that they may have in the future probably haven't crystallised yet. They maybe haven't thought about retirement or something like that far off. What we think it's about doing is it's about getting the right foundations in place, putting in place the right structures to then build on going forward. And that hopefully allows Charlotte and other younger clients to start thinking about their objectives in the right way. So it's not necessarily having a definitive answer now, it's about starting to get into the mindset to think about what your objectives might be.
And Dhana, I mean, do you have conversations sort of educating next-gen clients about if they are to receive substantial wealth, starting with small amounts but building up? What kind of conversations do you have on the sort of legal side so they start to understand the picture?
Yeah, no, we think it's really important. And I think we often underestimate that if you've never had to apply for a mortgage before, it's quite a daunting prospect. There's a lot of information, a lot of choice out there. So actually explain to beneficiaries, we can access help that will support you through this process, that will also make us feel better because the assets are being used for a purpose. We want to make sure that ideally that's preserved for you, that grows for you, that's always in your best interest. Trustees are often advised to be quite prudent with how the funds are used. So for a young person to have that amount just land in their bank account, that might not be the right approach. It might be that we are liaising directly with the conveyancers and that amount goes directly to them so that we have that reassurance that it's used for the purchase. Just because it ties everything up, it gives the reassurance to the trustees. Sometimes we even look at structuring that payment as a loan if we're concerned that that person just hasn't been used to receiving distributions. But also, as much as we say, this is a one-off, you can't guarantee, that's not how the trust works, that there's going to be an annuity given to you. It can be difficult for people to wrap their heads around that. And so structuring it as a loan and sometimes even calling that back in is really saying you can't just view this as a free-fall amount that you can do whatever you want for. It's trying to get that accountability, but actually doing it in a supportive way, because the younger we can start, the more these principles will make sense, the more they can learn to apply them. And we really see value being added by financial planners in that way.
There's a lot written about how next gens have a different view on the world and have different preferences and ideas about perhaps the wealth as well that's going to come to them. Do you see this in practice, or is that an oversimplification, do you think, or are there certain traits of the younger clients coming through that are sort of consistent?
I think that's potentially an oversimplification, because we also have older clients who care incredibly passionately about climate, for example. So I think we try to steer away too much from stereotyping, and all families have different dynamics. But we are seeing a demand for some of these principles to be introduced quite early on, but not necessarily meaning that you have to tell children about the trust, but doing some sort of separate charitable trust structuring, or perhaps just using a DAF to have those conversations and think about, perhaps those funds are temporarily invested whilst we think about how we want to apply those. And that also helps people think about the causes that they actually care about and introduces a bit of structure into discussions and encourages children to do some research. But I would say that if you get to 18 and you haven't learnt some fundamental principles about interest, compounding, debt, that's quite daunting. But if we've introduced it very early on, and perhaps not in a way about how it affects you personally, it can really just increase someone's confidence, because the last thing you want to do is bamboozle them with too much information post 18, be it 21, or the ages are potentially getting a bit older now as well. So it's about trying to really give them the tools to help the trustees, because if you've got sophisticated beneficiaries, that definitely makes life easier for the trustees.
Thank you. And Adam, just on the financial planning side, if beneficiaries are aware there's future distributions in the pipeline, how do they factor that into their own plans?
Absolutely. So it's really important to factor those in, and it all goes back to building a lifelong cash flow and financial model for a beneficiary, so they understand when money drops into their estates, how they can best utilise it to build long-term wealth. The main concern we have when distributions happen is, at that point, it's making sure it's not squandered. It's making sure it's used in an effective way so that it builds long-term wealth for that beneficiary. And it's going to have the best chance of meeting the sort of distribution objectives as well if we look after it properly.
And if within the trust deed there are certain dates where she'll receive larger distributions or incentives to undertake education, how does that affect the role that you would take?
Yeah, so it's the more certainty we have over future events and distributions, the better, because it allows us to be proactive. And what we want to do is have that conversation, have that education piece well in advance, so we've got that plan to run on. What we don't want are surprises and things coming out of the blue. So with Charlotte, for instance, it's making sure that in plenty of time she understands the key sort of financial planning concepts that Dana's already mentioned, so that when that distribution happens, it's not a big shock to the system. It's actually part of the plan we've already discussed, and the transition from not having the money to having it is smooth.
Is it common, Dana, within the trustee to have ages as kind of as milestones when larger distributions might be granted, or little incentives like educational fees being covered?
Yes, so often for more flexibility, we encourage that to be in the letter of wishes, because it's just so difficult to predict what may happen. Unfortunately, none of us can. So we like to have that as part of the guidelines for the trustees, but not necessarily set in stone. Some families feel more strongly about it than others. And I think a good example is the education. A lot of families do feel quite strongly about education, but actually in the current world that we live in, no one's quite sure how important that's going to be with technological advances, etc. And also, not every child is going to be an academic. So we had that recently where all of the drafting was about education, and the child's actually joined the business post 18 now, doing incredibly well. And actually, we had to rethink the documents. So you don't want to bind the trustees to not support people who are incredibly entrepreneurial and just really shouldn't be studying post 18. They should be out in the workforce blossoming. So it's an interesting dynamic.
And Adam, I mean, what's the danger of beneficiaries becoming too reliant on trust distributions, and how do you kind of broach that conversation with them in the planning?
Absolutely. So the big danger, I think Dhana already mentioned it a few questions ago, is if you're too reliant on the distributions, if they suddenly stop for whatever reason, then it's how do you cope going forward. So our view when we look at a client and we look at a beneficiary and help them build a plan for their finances for the future, it's one, obviously, how do they use the distributions to create the maximum impact for them? But also the other side is we often can look at a bit of a plan and go, what if these distributions don't happen? How do we use your own finances, your own income to get you into a strong financial position so that if they didn't happen for whatever reason, it's not the end of the world? So we look at both sides, sort of best and worst case.
And I mean, in general, mortgage is still driven off employment salaried income.
Absolutely,
I mean, how do you square the circle there with potential trust income? It can't be relied on, I presume, or when they're in their property search, they're going to have to rely more on what they can earn.
No, absolutely. So the distributions from the trust can obviously go towards paying the deposit and dictate how much lending you do need. But absolutely, when it comes to that overall picture and there's going to be a mortgage involved, we need to make sure that the beneficiary is in the right place financially for their own personal wealth to make sure they can lend.
And I mean, beyond the property purchase, Charlotte starts to have some spare cash to invest. How should she start thinking about investing for her own purposes?
Yeah, absolutely. So it's really just going, starting with the right foundation. So simple things like, everyone should be utilising their ISA allowance, but you can't get a more efficient way to invest. Looking at what pension contributions she's doing through her workplace scheme and if she's got any capacity to do more there. Once we look at those two sort of basic steps, if she builds wealth beyond that, there's various other things we can look at, but it starts with the basics and just building wealth in the right way. I always say it's just getting into the right simple habits.
Thanks. And Dhana, if the trustees they've looked at whether, at Charlotte's position, they're planning to make this distribution, is it a requirement for her to have some financial advice, or what's the position there for the trustees in terms of proceeding with this distribution where they're not sure how much she's familiar with the financial side?
So they can absolutely recommend that, of course, and then often trustees are drafted with really broad powers. So and when you do a deed of appointment from a trust, you get sort of certain indemnities and things like that. So obviously the trustees want to protect themselves in making the decision. So you could absolutely work that in because it's only going to be for the benefit of not only that beneficiary, but the other beneficiaries, because if that person then is coming back cap in hand for greater distributions because they haven't been able to invest that sensibly. So yes, I would say, and particularly if that's actually, we're seeing that within the letter of wishes where the settlor actually puts down who the current financial planners advisors are, says, I would like you to continue using them. I've worked with them over my lifetime. They really understand my investment philosophy and what my values are. And so that's really quite compelling when we explain that to beneficiaries, that this person really understood the person who funded the trust and what they valued. And so you can gain something from there. We do get a bit of attention where beneficiaries want to sometimes establish their own relationships, but we also caution them for not just changing things up for the sake of it, because that time of getting to know that family and the structure is very valuable. You can't necessarily recreate that very quickly.
Okay, thank you. And Adam, I mean, where beneficiaries have unrealistic expectations of future distributions, how does that conversation unfold?
Yeah, I suppose it can be a slightly tricky one, but I suppose it's just having that early and frank conversation. It all goes back to that being proactive rather than waiting for something to happen, so people understand what's likely to come going forward. And it goes back to that original education piece of setting expectations, asking those challenging questions if they need to be asked, if people have unrealistic expectations, and sort of making sure that well in advance of things happening, that they understand what's going on. And also making sure that beneficiaries understand that trustees have to act for the interests of all the beneficiaries, not just them in particular. So that can change it over time as well, what the best interest of everyone is.
And also, I suppose that the cash flow planning helps create some reality, doesn't it, on these situations? So to say, if you look at returns from a portfolio, you look at your lifestyle costs, if those things are out of balance, that can't be ignored, can it? So I suppose it's how you can use these tools to have those conversations about your cost of your lifestyle and what a portfolio can deliver. It's realistic.
Absolutely. So cash flow can do two things really well. One, it can help us see where we need to get to, what they want to achieve, but also it can be that slight sort of restraint and go, actually, based on where we are at the moment, maybe we need to tweak things because we're sort of looking at some unrealistic expectations. So it can often shed light on things that are difficult to visualise for beneficiaries before that point.
And I mean, Dhana, if Charlotte might be frustrated if she has friends who just simply receive money from parents. The trust structures aren't there, but why are the trust structures there? What do they help achieve to protect family wealth? Why do people still use them, do you think?
Absolutely. So a big part of it is asset protection. So we might have excluded the spouses of the children, the future partners of the children and the future generations, so that's really providing an additional layer. Unfortunately, the risk of divorce is quite high, just generally amongst the population. And the starting point in the UK would be a 50-50 asset split. So being able to say, well, these assets are clearly ring-fenced and they're not just used as a bank account. So they shouldn't be treated as forming part of Charlotte's estate, because that would be, I'm sure, personally devastating for her to know that those estates have walked away from the family when they weren't even earmarked just for her alone, but they are. Most people really buy into the idea of, okay, these are assets that someone's done well in the family and they genuinely want to provide, not just for your generation, but for your children. That's quite an easy concept for most people to buy into. Obviously more challenging when you're young, but people really do understand that, and it's a lovely thing to be part of. I think also, probably we've all seen it, that if money comes too easily, you don't appreciate it and you don't learn enough about it. And so that's also a difficult message to understand at the time, but most people setting up a trust do not want to deprive their children of ambition and achieving success on their own terms. So normally it's a pot. We don't want anyone to go destitute. We want to help and support you, where we can. Potentially if you're starting a business, we can get you past that first hurdle. So that's an amazing opportunity, but it's not that it's meant to fund your lifestyle, whatever you want to do. And so actually what we find is that even clients who can afford just to pay for everything, they're not doing that. And I think that's a very wise decision.
And how much do trustees need to know about a beneficiary's lives, future plans? Presumably they can't know too much, because it's whether they can, how much information they can gather. But what's the risk of not knowing enough about their clients?
I think if you don't know enough, then the trustee could be criticised for not considering relevant information. So that's one of the tests. They have to consider relevant information, disregard irrelevant information, and be reasonable. Do we think that, having looked at all of that evidence, that it was reasonable for them to reach that conclusion? So we would probably veer on having too much information is better, and to show that you actually looked at that and weighed that up. As we've already discussed, it's not always going to be possible to please everyone, but trying to get a bit of a balanced approach and stepping back a bit objectively, and also looking at what the future might hold. And obviously not everyone's having children, so actually we're finding that can be quite an easy way of meeting people's needs, because actually there might be a bit more of a defined end to a trust. In other situations there might be numerous minor beneficiaries, so we really have to think about, there might be health conditions. There is a sort of natural hierarchy, I would say. If someone has urgent medical needs, obviously that's going to be a priority. Some of the children might have special needs for learning, and so we're going to have to make sure that there's more support for that. So I think, although it does feel like an impossible situation, there are often a sort of hierarchy of needs that the trustees can work through.
Thanks. And Adam, if you were going to meet the trustees next week, what are some, based on this limited information, the scenario, what would you kind of be looking for? What would you want to know more about in order to kick off the advisory
Absolutely.
process?
So I think it goes back to that, having as much information as possible. So we'd really want to dig down a little bit deeper into the needs of the beneficiaries going forward and how that meets with the trust's objectives. We'd also want to be looking at how the trust and its assets are going to meet that liquidity requirement going forward. So I think in this case, there's a lot more information we definitely need to find out, and it goes back to that, doing a proper fact-finding process, sometimes asking those challenging questions that maybe people haven't thought about, but that's why we're here, I suppose, to help them sort of think about what they need to be doing and making sure that they're treading the path they need to.
Fantastic. Well, thank you for talking to me today. Look forward to sharing this conversation.
Thanks very much.